Okay, in this video, I'm going to talk about the direct method. That's one of the two methods allowed in preparing the operating activities section of the statement of cash flows. We've been doing the direct method, but I'm going to show you how it's done in real life. The way we did it in class and on projects, etc., is not practical in real life. The way companies do it in real life is they look at their income statement amounts. They take each one and then go to your balance sheet looking for the related account to get to the statement of cash flows. For instance, if the company sells on account and their accounts receivable did not change, then the amount of revenues earned would be the same as the cash collected. But that's typically not going to be the case. There's times when accounts receivable might increase. If accounts receivables increase, that means our amount that we earned on our income statement, we didn't collect it all. We had amounts of our receivables went up, which is cash we could have had, but we don't. So that's why you subtract from your revenues any increases in receivables. And then the opposite being, if accounts receivable went down, that means that we not only collected all that we earned, but we collected even more, making our receivables go down. The way I like to do it, if I look at it as this, an increase in accounts receivable takes a debit. Oops, sorry, not sure why that's happening. An increase in accounts receivable would be a debit. Just in my mind, think of it, well, then that's cash I could have had. So I credit or decrease, if you will. That is considered a use of cash. So if that's the case, my revenues are going to be on my income statement are going to be greater than my cash collected from customers. The opposite occurs if accounts receivable went down. That's credits to accounts receivable. That's basically, I got more cash than I had earned in that period. Now, this is not an entry that you make. It's just a way of organizing it. I have another video where I talk about it in terms of pluses and minuses if the debits and credits make you uncomfortable, but I'm hoping at this stage you're more fluent. I just want to show you in the notes up above, by the way, I'm in my the instructor notes, but if we look here as an example under Learning Objective 2, so you can kind of see the effect of what I was just talking about. Revenues on the income statement, that's why I have that red. So when you debit receivables, you're crediting revenues. Cash collected would be the same if this didn't change. If this was 22,000, this would be 100,000. In this case, you can see that it went down, receivables went down. So we not only collected all of our revenues, but we collected 2,000 more. That's a source. Deferred revenue, if you are a company where you collect in advance, let's take a look at this. It's kind of the same idea. Deferred revenue, though, is a liability. So in this example, let's just go with this, if our deferred revenue did not change, then these would be the same. The amount of revenue earned would be the same as the cash collected. In this case, if you notice that it's going down, to get deferred revenues to go down, that would be a debit to deferred revenues. I look at it as the other side as a credit. That would be a use of cash. So back to this diagram I was showing you. If you look at deferrals, deferrals increase with credit. So I make the other side be a debit to cash. So in other words, that is a source of cash if the deferred revenues went up. So my cash collected in that case would be greater than my revenues. I would be adding that to my revenues to get cash collected from customers. Opposite, if my deferred revenues went down, the other side is a decrease to cash. Again, these aren't entries. It's just a way of having a logical way of looking at it. So here we go. If my revenues, excuse me, I take my revenues, I start with my revenues, And then as far as I am going to subtract any decreases to get my cash collected. Because basically what's happening is I didn't collect as much as I earned. Expenses are kind of the opposite, but same idea. So in this case, expenses, you debit expenses and you want to get it up to the amount of your cash paid for expenses. Well, you got to go to your balance sheet and look at the related account. By the way, all these related balance sheet accounts are going to either be a current asset or a current liability. Those relate to operating activities. We are doing the operating activities section of the statement of cash flows. Okay, so with expenses, these would be the same if we didn't owe anything, right? Or if there was no change in what we owe. Accrued liabilities are all your payables for expenses you've already incurred but haven't yet paid. So as far as how I look at this, again, using debits and credits, if you'd like, again, I have another video showing it with pluses and minuses, but I look at it this way. If accrued liabilities went up, put the other side to cash, accrued liabilities go up with credits, right? I'm just going to write AL if you don't mind for accrued liabilities. So this is a source. So basically what's happening is I had a bunch of expenses, but to increase this account means I didn't use cash. I used more IOUs. I gave IOUs instead of cash. So your expenses on your income statement will be less than the cash paid. That's a source. The use is the other way around. If my accrued liabilities went down, that means I not only paid for my expenses, but I paid even more. It takes cash to reduce those liabilities. So that's a use of cash. So in this case, I have not just my expense, I also paid even more cash to reduce these liabilities. All right, deferrals, the opposite. They're a little more involved. Prepaids are pretty straightforward, so let's use that one. In this case, I am, if I have no prepaids or no changes in prepaids, again, prepaids occur when you pay in advance for an expense that you, in other words, you're prepaying, meaning you're paying in advance of getting the service. So it's an asset until you actually get the service. So in this case, if prepaids didn't exist or didn't change, our expense would be the same as the related, say, cash paid for insurance or advertising or rent. So what we have to do is look at the balance sheet, though, and see, is there any prepaids? And if there's an increase in prepaids, that's a use of cash, because if you think about it, so to get a prepaid to go up, and actually to get any of these to go up, is a use of cash, because you, instead of having more cash, you have more of this current asset. So the effect would be a use of cash. Opposite if it goes in the other direction. If you have, if you have a decrease in your prepaid or your supplies or your inventory, it means you're using what you already have instead of using more cash. You're using an asset, a current asset, rather than the cash. So it's a source of cash. So with expenses, if it's a use, it means we not only paid our expense, but we actually even had to pay more. So our cash paid for expenses is greater. With the opposite being, this would reduce the amount of the expense. In other words, our expense would be a certain amount. We can decrease that amount. In other words, the amount of your expense will be less because you're going to subtract that decrease. Now with supplies and inventory, you might buy them on account, and more likely than not, you buy them on account. So we have to also look at the related payable account. So with supplies and inventory, there's two steps to it. You go from your expense, you look at what happened to the asset account, and then you have to go look at the related payable account. So supplies payable, you'd have to see whether it increased or decreased. And again, just like the accrued liabilities, notice that an increase is a source of cash and a decrease in the payable is a use of cash. Hope that helps. There are plenty of examples, but you do want to have your way of analyzing how to get or what to do, let's say it that way, with a change in the current assets and current liabilities to get to the statement of cash flows from the income statement. In other words, to get from an accrual-based number to a cash basis number. I hope that is helpful. Again, there's another video under the indirect method where I just use pluses and minuses, but this is safer, I think. All right, hope that helped.